So basically, this is our coronavirus version of our annual conference. And we have a grant from Robert Schalkenbach we usually get a grant for the conference. We got a smaller but still substantial grant to do the conference on video. So we're grateful for that. And and so we have our featured speaker is Richard Vague, and Polly Cleveland is our local economist who got us in touch with Richard and has got good connections on land speculation and banking. My focus and Polly's focus is more at the land speculation side of it and at the land speculation side of it and the land value tax aspect of reducing that speculation. And Richard's focus is more on the banking side of it. And I will turn this over to Polly, who can introduce Richard better than I can. Thank you, Polly.
Oh, you're welcome. Well, again, thank you, Richard, for joining us. This is a very exciting session for me. Richard has an extraordinary background as a banker and owner of a succession of, well, 2 credit card companies, the last one of which he sold to Barclays. And somewhere along the way, I think his story is, while he was selling his second credit card company to Barclays, he got curious about the boom and bust cycle, and maybe he can tell us a little bit about that story, about how the bankers didn't seem to worry about the quality of collateral in the middle of a boom. In any case, when I read Richard's book, I heard him speak at a conference just a year ago, and it was, for me, it was an incredible revelation, because his work, his research fills in what I always thought was kind of a missing link in Henry George's theory of land value taxation, and the boom and bust cycle. George was aware that the boom and bust cycle had something to do with banking, but he wasn't really clear how. He threw out a theory in Progress and Poverty and then never referred to it again. He knew there was a connection to money, and I'll read the quote from the book, which is that the essential defect of currencies, which contract when most needed, and the tremendous alternations in volume that occur in the simpler form of commercial credit, which to a much greater extent than currency any form constitute the medium or flux of exchanges. So George had some idea of a connection, but Richard really filled it in, because what George didn't know and couldn't know was the role of bankers, you know, those totally super respectable members of society. And who would have thought it was crooked bankers running wild, funding the speculators? And that's, you know, it takes 2 to tango. So it was a kind of a collaboration between crooked speculators and crooked bankers that lies behind the boom and bust cycle. And then, of course, eventually when the bust happens, the bankers panic and they take away credit, not only from the speculators, but from everyone else. And that's what causes the depression part of the cycle. So in any case, this is Richard's book, which for me was just was a tremendous revelation, and I'm very excited to be able to introduce him to speak to you today. He'll go through his basic model a little bit with some sizzling examples from the Roaring '20s, and then I hope we can move on to some questions about our current COVID crisis and what the implications are. So Richard, you could take it away.
Thank you so much for that very kind introduction. I'm going to try share. Yeah, I think
Yep.
perhaps
Got
that
it.
does it. I am so grateful to you folks for including me today. And I am so grateful for those in the audience who are taking the time to join us. Thank you very much. And I owe a particular debt of gratitude to Polly, who is one of my mentors and one of the smartest folks I know. So these days, there's nothing that no new theory that I concoct that I don't have her vet before I embarrass myself. But it's been quite productive relationship. So thank you, Paula.
Well, thank you.
So I wrote the book, A Brief History of Doom, which came out fairly recently. And it was an in-depth study of 43 crises over 200 years in the 6 largest economies in the world: Japan, China, Germany, France, England, the UK, and Germany. So
In the United States. You left us out.
oh yes, that small country in the Western Hemisphere called the United States. We had to unearth a lot of previously unused data, particularly around lending in the 4 or 5 years prior to the crisis. And for the very reason Polly suggested, folks have kind of ignored what was happening in private sector lending in the period prior to a crisis. And it was our thesis that it was that very lending and the rapid buildup in that lending and the irresponsible loans that were being made that led to the crisis. And so you'll see a lot of original data in the book that we hope is useful. I'm trying to advance the slide now. I'm having a little trouble.
Uh-oh. That's what I was, that's where I said you have to put the, you have to set the slide to if you close the slide and tell it to go into PowerPoint in the slideshow options and tell it to open in a window instead of in the full screen, it should, let's see what you get. Nope. We had this problem last week with Zoom, is that the slides didn't advance. Set up slideshow up toward the left, right from there. Go to the right. Nope.
Okay, so now we're set.
Oh, okay, maybe.
So thank you. So what I'd like to present to you is a crisis paradigm. And I think what happened to Japan in the 1990s in late 1980s and 90s is instructive. You can see the red bars are the ratio of private sector lending to GDP. And you can see starting in about the mid 1980s, it accelerates dramatically. And it continues to accelerate through the mid 1990s, which is the period in which the crisis unfolds. And what has happened is they've just made a lot of loans, particularly for commercial office space, for which there are no tenants. Therefore, there will not be rental income. Therefore, the loans will not be repaid. And they made these all over Japan, but they also made them in California and Hawaii and many other places. It resulted in excess capacity or over capacity. And that, in my mind, is the essence of a financial crisis. Is you have way too much capacity. That could be in railroads in the 1800s. In our current, in the 20th century, it was more likely real estate. Certainly in 08, it was real estate. When you got a lot of bad loans that aren't getting repaid, the lenders fail. And that's really the heart and soul of what's going on. And by the way, the economy doesn't restart very vigorously until the overcapacity is absorbed. All the unsold houses, all the unrented buildings, or whatever it is, it takes years to absorb the overcapacity that's been created. And we could take you through all 43 crises, but we'll just touch on one or two more. The 80s boom. This was, by the way, my formative experience in banking. The 80s boom, for which Reagan and Thatcher get so much credit, was in fact, a runaway lending period. You can see in the US between about 81 or 82 and 87, private debt to GDP grew by about 20 to 25%. The growth was even more radical in Thatcher's Britain. You can see from 81 to the end of the decade, it grew from about 70% to about 130%. So it almost doubled in that period. And of course, that created enormous excess capacity, which resulted in the S&L crisis. Those of you who remember the Reconstruction, the RTC in the United States, it created great problems for Thatcher and Reagan's successors. George Bush, who inherited the problem and thus lost to Bill Clinton, and John Major, who presided over losses in a great recession in the United Kingdom. China is another market with remarkable and problematic private sector credit growth. And China had its first major crisis circa 2000. It actually rolled out over several years. So from 99 through maybe 2002 or 2003. You can see on the left-hand side of this chart the rapid growth in private sector lending. It resulted in bad debt within the banks in China as high as 30 or 40% of loans outstanding. Now, in the United States, if a commercial bank has 2 or 3 or 4% bad loans to total loans, the bank probably fails. In the case of China, it got up to 20 or 30 or 40%. The government had to intervene massively to save the industry, but it did so very skillfully, by the way. And then, of course, we had our debt boom. You can see that from about 03 to 08, 7 or 8, in which our debt boom financed China's big export boom. Then we had the global crisis in which China once again had to lean on rapid private credit growth to kind of bail it out of its problems. And really over the last couple of years has been on the precipice of its own new financial crisis, with the government again having to intervene quite forcefully. The basic pattern then is big lending sectors where you have excessive lending. Another thing that I would point out to you, and this is an underappreciated fact, but for most crises of this type, it doesn't start in conventional commercial banks because they're too thoroughly regulated for these kind of problems to crop up quickly. Instead, it starts in a secondary or tertiary type of financial institution where regulation is either more lenient or absent altogether. We saw this in 08 because it wasn't commercial banks, but mortgage banks where the problem originated. We saw this in the 1980s where it wasn't commercial banks. Instead, it was the savings and loan industry, which, as we know, became a protected industry from a regulatory standpoint. Remember, the Charles Keating Five is one example of that. But it was in most of the crises we looked at over 200 years. In 1907, it was trust banks or trust companies, not conventional commercial banks. We saw that in Germany in the 1870s. We saw it, in the real estate bond lenders in the 1920s. Again and again and again, it's a secondary or tertiary type of institution which starts the overlending, which really then becomes widespread subsequent to that. I want to talk just a little bit about the Great Depression because it's illustrative of the whole principle. What I've said is the heart and soul of most of these financial crises is overcapacity. And here you can see it dramatically illustrated in the 1920s in the United States. The black line here is total construction spending. And you can see that by 1927, 1928, it's 4 times greater than it was at the end of the 1910s. Massive overcapacity was being created in the residential real estate market and in the commercial real estate market. And it wasn't just in Florida. The real estate boom in Florida was smaller, frankly, than similar real estate booms in Chicago, New York, and other parts of the country. It took a decade or more, frankly, for that overcapacity to be absorbed. And the overcapacity was not created because demand was stimulating it. I think the other thing that's at the essence of financial crises of this type is it's lenders and real estate developers who are out to make a lot of money. And in the case, Fred French is an illustration of this in the 20s. He figured out how to use a battery of salesmen, which reached 150 people, who would sell investments in yet to be developed office buildings and housing developments to the man on the street in denominations as low as $100. And these equity investments nevertheless paid dividends, which is one of the main things that made them so easy to sell. They were raising so much money that they had to go out and recruit developers to build projects to raise the money that they had, to spend the money they had raised. It was rampant overdevelopment. I think here's another illustration of how much overcapacity was being created. You can see in the 1920s, again, more skyscrapers were built in this period than in any period of the 20th century. It took quite some time for that to be absorbed. You can see the overcapacity in our recent global recession. You can see the blue bars here are homes sold, both existing home and new homes. Another thing I like to point out to people is this overcapacity had fully been created by the end of 2005 and the beginning of 2006. So what we think of as a crisis that began in late 2007 with the collapse of the stock market, and then late 2008 with the collapse of the Lehman Brothers, was in fact a lot of homes that had been built, sold, and financed, including the subprime portion of that. Most of that had been created and financed by the fourth quarter of 2005. And that's why the savviest investors were able to make their bets in the form of credit default swaps and make such enormous amounts of money in 2007 and 2008. So at any rate, a couple of comments about this, and then I'm going to talk about the current COVID situation. What kind of policies can prevent this particular type of crisis, which has been the largest type of crisis over the last couple of years? One is for lending regulators just to watch the growth of loans. What we see is growth of more than 20% in loans to GDP in a 5-year period results in a financial crisis about 80 or 90% of the time. It doesn't take much to see a trend in that direction and begin to dive more deeply into the credit policies of the lenders in that market. Didn't take a genius in that kind of growth to go into something like Countrywide and see the fact that they were not requiring down payments, not checking on income was a problem. And from a regulatory standpoint, to issue cease and desist orders or otherwise intervene. Another policy that I would recommend here is broader oversight of the regulators, such as the Federal Reserve. The Federal Reserve has gotten some of that coming out of Dodd-Frank, but more powers to intervene broadly when rampant overlending is occurring in secondary and tertiary types of financial institutions seems in order. One other comment I'd make about this particular crisis before I move on is the government did act to help financial institutions. The government did not act to help households. of the 52 million mortgages in the United States at that time, as many as 15 million were underwater by the time you got to 2009 and 2010. And those mortgage holders needed significant relief, which was not forthcoming in any but the smallest amounts. And I think you had a disenchanted, 10 million, 15 million households that for whom not much had been done in the intervening, what would have been, 6 to 8 years, that were vulnerable to the promises of the Republican presidential candidate in 2016 in a way they would not have been if they had been helped differently. But at any rate, enough on that. So I want to comment briefly about the Depression of 1920, which was not a financial crisis of the type that we've just been discussing. It came in the period of 1918 to, let's say, 1921 or 22. It was not a result of rampant overlending in the period prior to 1918. It was instead a function of two things, maybe three things. One of those was the drop in spending post-war that normally happens as a country demilitarizes. So you had a big drop in spending, and that's sort of what we're seeing, not sort of, that's what we're seeing today because of the lockdown. So there's a parallel there. Secondly, during this period, you had a significant pandemic in the spring of 1918 in a dramatic way in the winter of 1918 and 1919 with echo effects after that. So you had a global pandemic where, I think 700,000 people in the United States perished and as many as 100 million globally perished. So you had lockdowns, not of the duration we think we'll see now, but of significant duration. And the other thing you had was this odd seeming juxtaposition of a depression and inflation. And the depression was certainly the function of the collapse in spending. The inflation was simply a function of the fact that a third of the farms in Europe had been taken out of commission and were not producing. The United States ended up exporting perhaps as much as 20% of its wheat and corn and other grain crops to Europe to try to address the famine. So you had inflation, but it was really just in that ag sector and it spilled over. So, it's not a perfect parallel, but it's illustrative because it has similar features. And what I'm showing you here is that real GDP had not made it back to 1918 levels by 1921. It finally did in 1922 and 1923. So you have a phenomenon that lasted a good 3 years. And I think that's a relevant milestone when thinking about how long our current situation might last. I think you can see that the Dow Jones had not recovered. It was reached 107, if you can believe that low a number, 107 in 1919. It was not back to that level by 1921. You can see that the inflation levels greatly exceeded 10% in 1918 and 1919, but we had 10% deflation by the time 1921 came around, which I think is really more indicative. And lastly, you saw unemployment go from less than 2% in 1918, which is what happens to unemployment when you have a lot of soldiers employed fighting a global war. And that skyrocketed to 16% by 1921. So I think if for no other reason, there's just kind of a framework there that might help inform our expectation of what's going to happen in our current crisis. And sure enough, we're kind of off to a bad start. Here I show you GDP. The blue line is GDP in the Depression. You can see it rise from 1928 to 1929. and then it collapsed through 1930 to 1933 by a nominal 46%. And, you know, it was only about, if I recall correctly, about 12% the very first year. Now, look at the red line, and that's the current Fed nowcasting estimate, if you follow the nowcasting report. Nowcasting estimate that in this quarter, GDP will be down 31% in the United States. That's not a small number. Now, that may not be reflected in the full year numbers. It might be a smaller number than that. But I'm going to tell you that it's probably still going to look bad relative to what happened in 1930 in the United States. And this is my last slide. And I just, you know, Polly and I talked about this, but this is just a kind of a what to watch for slide. This is all private debt in the United States as of a couple of years ago. And you can see how disproportionately oriented to real estate debt U.S. lending is. If you look at the home, it's about 30 trillion, and you can see home mortgages are 10 trillion of that, and commercial real estate is about 4 trillion of that. So in essence, half of all the lending done in the United States is just real estate. For comparison, look at the energy sector, which is only about 900 billion. And I say this to say, there are sectors that can have very big problems, and no matter how big they are within that sector, they're still not going to be big enough to have dramatic, ripple effects in the economy. We had a huge energy debt problem in 2016, and most Americans didn't even notice because the whole sector is only about 900 billion. You can't have a problem in the real estate market without everyone feeling it. And so that's where most of my own attention is going to be paid. Right now, there's only about 10 or 12% of mortgages that are either delinquent or in a forbearance program. It'll be very important to see where that trend goes over the next couple of quarters. You know, if it doubles or triples over the next couple of quarters, we're in for some rough times. If it stabilizes closer to where it is, that's a very good sign. So with that, I will thank you and turn it back over to you, Polly, for any questions or comments.
Well, I think we have a whole list of questions coming in from the audience. But let me just leap to the grand solutions, because I know, Michael Hudson has proposed that we need a total debt jubilee to solve this problem before everything collapses. And I wonder whether you agree with that. How could that function? Without destroying the whole banking system?
So I think Michael Hudson is terrific. I think his work on Jubilee over the last several thousand years is some of the most important work that's out there. He and I have actually had a discussion about this because what I try to remain cognizant of is what is politically feasible. Michael taught me a new term as we were having this discussion, the Overton window, kind of the range of solutions that might actually have a chance in Congress. Nobody would like a jubilee for households more than I would, and I've written about that myself, and actually proposed ways to do that don't create unfairness, I believe. But I think right now, since a jubilee is not something U.S. Congress is going to do anything about anytime in the near future, I think there's two things that are needed right now in a big way. One of those is support to states and municipalities, where if support is not forthcoming, we're going to have significant issues very quickly. And I think that support needs to be in that 500 billion to $1 trillion range. And then the second thing I think we need is more direct, ongoing support for households. There's a variety of ways you could do that. One of them is through unemployment. One of them is direct checks to household. In Europe, they've done payment continuity programs. Take your pick. As long as it's sustained and ongoing over a period of multiple months. Those are the two acute needs that I think we have right now.
Let me just ask one more before everybody else jumps in. You are currently Pennsylvania's acting Secretary of Banking and Securities. You told me that also had something to do with insurance. But the question is, how is Pennsylvania and Governor Tom Wolf handling the COVID-19 crisis? What are the options for Pennsylvania?
Well, I think Governor Wolf, whom I'm a huge admirer of, is doing a magnificent job under extraordinary pressure. And the pressure in Harrisburg is intense. It's 24/7 because there is this acute need for businesses to open up. And there's an equally acute need for us to preserve the health of the citizens of the Commonwealth. And that's an excruciating, vortex, if you will. And as you've seen, the governor has opened up a number of counties, including on Friday. I think we're going to see more forthcoming very, very soon. So I think he's achieving that balance. But and it's not just Governor Wolf, it's governors throughout the country are dealing with a problem that's unprecedented, certainly in U.S. history.
How are you dealing with the testing, though? I mean, you can't safely reopen without testing.
You have hit the nail on the head, and every effort that can be expended. I'm not only involved with the Commonwealth of Pennsylvania, but as you know, I serve on the Board of Trustees of the University of Pennsylvania healthcare system. Every single bit of effort that can be expended towards increasing testing capacity is being expended. And we haven't moved as quickly as we've needed to as a country there. We need to accelerate that, but a lot of effort's being put into it.
Oh, thank you. I think there's, I don't know if Dan has them or Sue has them. There's a whole list of questions that have been popping up. So maybe, is it Dan? Do you have the questions?
Yeah, and I have a few of my own, and then I have several that people have asked. One is that you talk about excess capacity, and it strikes me that the excess capacity is very much tied to the land speculation element, that there's no increase in capacity of land, so that when there's a building boom, the price of land goes up. So like the home builders not only have to keep building more homes, but every home they sell for more money than the previous year, because and this creates a panic in the buyer. The buyer is in like a defensive speculation, because if he's in a place like California, he's saying this house is $700,000, but next year it's going to be $750,000, and the year after that it's going to be $825,000. So part of the excess is not exuberance, it's almost fear on the part of the consumer that if he doesn't buy now, the price will keep going up. And so he's willing to overpay, and then when the price goes down, that's when he's in negative equity. So Pittsburgh had a land value tax till 2000, and when the 2008 crisis came, for the 5 years after that, we had the lowest per capita foreclosure rate of any large city in the country, and we also had the lowest share of underwater mortgages, of negative equity mortgages. And California as a state had the highest share, and they traded that off from time to time with Nevada, because Nevada also has very low property taxes. They get a lot of money from mineral royalties. I thought they would get a lot of money from gambling, but they actually get a lot more from mineral royalties. So that was the first thing, was that this excess capacity is tied to some artificial incentive. And the exception I thought of was the dot-com bubble. But it was also, if you don't do this now, somebody else will do it, and they'll get the patents and they'll get the copyrights and you won't. So there's some kind of artificial act now incentive that seems to tie to this. It's not that, you know, even with railroads, it wasn't that there was too many railroads, it's that they were speculating on these massive land grants that the railroads were getting, and the railroads were going to make their money developing this land. So
yeah, I mean, you're absolutely right. And so it's a herd mentality, but that herd mentality, I think most importantly affects the bankers themselves and the loans they're making. So, you know, before, you know, the herd mentality, you know, kind of infects the buyers of home, at some point in time, lenders started lending too much. And it's the act of lending that causes the property values to go up. And that's what I think bankers consistently miss. They're thinking that they're chasing a trend when in fact they're causing that trend. And one of my favorite periods in which that happened in a massive way was one of the biggest depressions in American history, which came in the 1830s, when the sale of federal land, which in 1830 was 2 million acres, by the time you get to 1836, it's 24 million acres. You know, over 10 times as many sales are occurring, all financed by credit. And that brought almost a full decade of woe.
yeah, I'll just mention, there's an excellent book by Daniel Friedenberg called Life, Liberty, and the Pursuit of Land. And it's about this massive land speculation, politically driven. Congress members were a big part of it. Occurred right after the revolution, and some before, but after the revolution, there was just a field day on land speculation. The next thing I wanted to move to is we have these recessions, but 2008 was particularly severe. And I've been wondering if I saw in your book that there's too much emphasis on government debt and not enough emphasis on private debt. And it struck me that we had this crusade against deficit spending in government. And so the lack of government debt means that there won't be enough money in circulation unless we accept more private debt. And I don't know how that mechanism would work out, but I have the suspicion that we, as regulators, under the political repression of deficit spending, ended up accepting more private debt than we might have otherwise.
You know, perhaps that's true. But what I would say is, having looked in depth at 43 of these, government debt tends to not be a factor. And so you have crises where the government debt was rising, crises where the government debt was falling. It is, to your point, a little more typical for the government debt to be benign or falling. So perhaps there is some linkage there, but as a general matter, it's bankers trying to make big bonuses. And so, you know, it's government debt does not contribute to overcapacity.
Okay. And
Let me just put a
go ahead.
Just put a point in about overcapacity. A lot of that overcapacity is never useful, and particularly when you have, you know, speculative vacation lots and speculative, the developer would come in, buy a farm, build a clubhouse, dig a lake, plot the land, and sell off the lots to suckers. Now, and often, you know, this is property that never would be and never will be developed, you are left with what are sort of financial brownfields. That is where the people have long since disappeared. The titles are lost, but a lot of that just never, you know, it's not overcapacity.
The overcapacity is solved with a bulldozer in those cases.
Yeah, well.
The other thing is, you brought up the Jubilee and the non-borrowers, and what Michael Hudson had pointed out. One of the things that struck me is that the reason the banks were in trouble is because the mortgagees were defaulting. And had we bailed out the mortgagees, it would have automatically bailed out the banks. And so I never saw the logic of passing right over the mortgagees and bailing out the banks, except I do remember that the original Tea Party outrage was over the prospect that we would bail out the mortgagees. And
your point is excellent. You could have solved kind of a series of problems by going straight to the household. And you're exactly right. The Tea Party was formed, around the outrage over helping mortgage folks, which remains a mystery to me. So.
Yeah, there's a thing in the Bible, and I wish I thought of it earlier, then I would know the chapter and verse. But there's a thing in the Bible where the king goes to all these people who owe him money, and he demands that they come up with the money in some reasonable period of time, and several of the people ended up saying, well, people couldn't pay it, and so I didn't squeeze them. But this one person ruthlessly squeezed them and still didn't come up with the money, and the king ruthlessly squeezed him. It was the notion that if you're going to treat those who owe you money with this ruthlessness, then I'm going to treat you with the same ruthlessness. And that seems to be instructive as to what we should have done.
The spirit. Yeah. The work of Hudson and the work of a gentleman named David Graeber in a book called Debt, the First 5,000 Years, shows a lot about the interconnectedness of too much debt and religion over several thousand years. And those are two books I'd recommend to anyone. They're both extraordinary.
Yeah, my only problem with Hudson is he tends to vilify people more than I would. It takes away from the problem-solving atmosphere. Often he's right, but he doesn't need to put it in terms of good and evil. He can just put it in terms of this is what happened and why it doesn't work.
I happen to agree with you on that. And, there's a few folks on that side that I just think have been fighting the fight for so long that they've adopted that posture. But
yeah,
I agree with you.
Are there questions that have come in on the Q&A or the chat?
Yeah. Daniel Twet, I think it's Twet or Tweet. He notes that there's a cycle, that this financial cycle is similar to other cycles, the biggest of which is the rise and fall of empires, that you have an empire becomes oppressive, there's a revolution, there's liberty. After liberty, there's prosperity. With prosperity comes inequality, and with inequality comes oppression again. And I've even seen this within like nonprofit organizations and stuff. I see the little microcosms of this. But he just observed that and wanted to see if that cycle resonates with anything that you're suggesting.
Sir, once you get back past a couple of 100 years, there's just not a lot of data.
Yeah.
But there's a lot of evidence from various histories that this was a big problem in places like Rome and Greece and others. But we just have to kind of reconstruct it indirectly. So I suspect he's exactly right. Now, when you get into the modern period, the United States, we had crises in, 1791, 1796, 1819, 1837, 1857, 1873, 1884, 1893, 1907, 1914, 1929, and so forth and so on. So clearly those all happened within the window of the same government being in existence. So, to me, it's almost like a generational thing. And this was also true in the UK, where you had it like 1848, 1857, 1866, I think 1879. So I tend to think of it as, defined by the memory span of the credit departments of the lenders. Once the generation that had to live through that has retired, and the new guys who have a lot more self-confidence, having not gone through one of those, get into this risk management chair, that's when you have the next one.
Okay.
Well, that's the origin of the 20-year cycle, the roughly 18-20-year cycle.
Yep.
Fred Foldberry wanted to know how central bank credit expansion ties into this.
You know, the central bank credit expansion tends to happen after the crisis. It's it parallels government debt creation. So in the ones we examine, typically up until the point of crisis, central bank expansion, and we've looked at this in great detail in the United States and in the UK. Of course, for an extended period in the United States, we didn't have a central bank, but government debt and central bank debt tend to be very benign, not always, but as a general matter, up to the point in crisis. And the big expansion in government debt and the central bank debt happens as a result of the propping up of the economy after the fact. I was just reading this morning about 1866 in the UK, which is, I believe, where the term lender of last resort came into play, from a gentleman named Walter Bagehot, who was the editor of the Economist. And there were vigorous debates around this, folks, including directors of the Bank of England, taking both sides of this question. But the expansion of the central bank comes after the fact, as the central bank intervenes to prop up troubled institutions, and it tends to be dramatic, and we saw this in 08, where the central bank had been 900 billion prior to the crisis and grew up, I believe, to about 4.8 trillion before settling back down at about 4.4 trillion. And now I haven't looked at it lately. I suspect it's 6 or 7 trillion now, on its way. Now I want to put that in perspective too. The United States Central Bank has actually been small compared to the other big three central banks, if measured as a percent of the GDP. So, the four big central banks in the world right now are the ECB, the PBOC, the Bank of Japan, and the US Fed. And the US Fed, as of December 31st of last year, was only about 20% of US GDP. Bank of Japan was 100%. Wow. The Bank of Japan's GDP. And the PBOC and the ECB were about 40% of the respective. So it's not like we were already unwieldy in size. I think frankly, personally, I think there's room for the Fed to be, 5 or 10 trillion in size, maybe even higher than that, and that not be a problem.
Well, but doesn't that matter where the Fed is putting the money? At the moment, they are bailing out a lot of foreign banks too.
Yeah, particularly through the swap facilities.
Yeah.
Which I think is right now back at a few $100 billion. Mm-hmm. Absolutely, the credit of this, but this is not a new phenomenon. It's new for the Fed, but it was routine for the Bank of England to reach out directly to discount houses, which were not banks, and buy their paper, back in the early 1800s. So this question of how the quality of the collateral you're taking has been around for a long time, and I suspect the Fed is a little bit further out on that spectrum than maybe some of us would like. I don't think it's problematic.
Do we have a smaller reserve requirements than the Japanese or other central banks? It seems like our reserve requirements it's no longer a fixed ratio, but it seems to have gotten so small that as long as a bank has liquidity, it can lend more or less unfettered.
I think that's true, but in my experience in the banking industry, the more important ratio was always capital. We were rarely constrained. I don't ever recall being constrained, frankly, by the reserve requirement dimension of the puzzle. That we were always pressing up against our capital requirements.
Does capital include the debts that are owed, the collateral, or?
Capital is primary capital, and we tend to also count the reserves established against loans, those two things.
Right.
Okay. So if the collateral includes inflated land values and then there's a recession, the collateral tends to diminish.
Well, to talk about it simply, if your capital was 100 million and you had a $10 million loan that was collateralized by 10 million in property, and that property declined in value by 5 million, you should add $5 million to your reserve. You should charge 5 million against your reserve, and your capital should decline from 100 million to 95 million instantly. Well, we all know the truth is that banks are slow to recognize, diminishment in the ability to pay. That defines Japan in the 1990s. Japan, the banks and their regulators basically looked the other way, and they weren't honest in recognizing their losses for, I think, probably 8 years.
Jeff Grabert wants to know, do you think replacing debt currency with currency backed by land in the commons, I guess that involves a land value tax or something that would generate rent, would give homeowners free and clear title to structures, and using the ground rent to eliminate taxation and provide basic income would solve the problem? I think that requires some serious Georgist analysis to deconstruct. But the basic,
I'm not sure I understand that one. So I mean, certainly the value
I
of
understand
land
it, but
is a
it's still
very
so
important thing.
confusing. I don't think I can explain it.
Why don't we commit to study that one and try and respond after the fact?
Somebody wanted to know if this can be shared with Stephanie Kelton. We are going to put it on YouTube, so it'll be up to somebody to.
Well, I know.
She's on my list. So.
I know Stephanie, and she knows. I think Stephanie's terrific.
So does this attendee, by the way.
So she's one of the most well-known proponents of modern monetary theory. She's an excellent professor of economics. She is a gracious and realistic commentator on things. She certainly knows the things that I know about financial crises, and we've been in discussions about that. So I'm confident Stephanie knows this stuff. The principal kind of task of the modern monetary theory guys right now is just giving comfort to any audience out there, Congress being probably the most important one, that deficit spending is not going to create problems. I tend to agree with that. I have a few concerns that are kind of different than most people's. I think the rapid expansion of debt actually causes interest rates to go down. That tends to be the opposite of the general belief in that regard. And I think that there are consequences of low interest rates, not the least of which is exacerbated inequality. But I think those problems are small relative to the need we have right now for expanded government support. And so Stephanie's message is an important one right now, and I'm glad she's making it.
There's this is mine, but it's a follow-up to that. There's three major closely related monetary reform efforts. One is MMT, which seems to focus on the deficit spending, on the idea that we can create more money, but doesn't put much emphasis on curtailing the bank creation of credit during the boom times. There is the positive money, and in the United States, Alliance for Just Money, which emphasizes that we could create a lot more money if we were better at curtailing banks from creating credit. And they have, they're tied to something called the Chicago Plan, which came out in the 30s, which was that government would lend all the banks. The government would require the banks to have 100% reserves, but it would lend them the money to fulfill that. And from that point forward, the government would decide how much additional money to lend the banks and how much money to put into circulation by deficit spending or tax cuts. And the third is public banking, which basically, and Walt McCree, I don't know if you know him or not, he's also in Philadelphia. He's he's big in the public. It's Ellen Brown is the main person, but he's big in that, and he's going to be speaking Tuesday evening on our next Zoom chat. And he has, his idea is that if the state of Pennsylvania created some kind of an authority which owned a bank, that bank would, they have a Bank of North Dakota, which doesn't necessarily transcribe to a state the size of Pennsylvania, but it might. But he says that, you know, all our pension funds and other obligations could become collateral of our own bank, and our own bank would lend back to our municipal governments and our state government. So it would avoid, you know, us getting a low percentage on our bond, on the money we have to have in reserve for our pension fund. And so like Pittsburgh is paying money into a pension fund, and it's also borrowing money for other projects at a higher rate than the pension fund. And so it's like me having money in the bank that I borrowed at 6% and put it in the bank at 4%. And they're saying if you have your own bank, that differential pretty much comes back to you. And I don't know if you know anything about any of those three things you want to talk about.
The three different lines of thought that you just represented have in common the idea of somehow constraining overlending by banks. And that is a very useful idea, and it's the exact idea that I espouse. I just have a kind of a simpler, more straightforward way of dealing with it, which is, you know, more vigorous regulatory oversight. But I think the idea of banks not kind of taking, not banks, but lenders, I would say, taking leave of their senses and starting to make trillions of dollars of loans at 100% loan to value, not checking income, is something the regulatory community ought to be more vigilant about.
And I think yours is much more within that Overton window. Yeah. I've always had this image when somebody says government should just regulate the banks better. I always had this image of a small child with a large dog on a leash, and it seems to be working fine until the dog spots prey. So, you know, what I think I agree with, you know, I think I agree with that, but it has to be simple. If the regulations get complex enough that people aren't really paying attention, I'm worried about that.
Well, Charles Keating in 1986 or wherever it was, it's a great example. You know, he was clearly in violation of the savings and loans regulations, but to the tune of, you know, hundreds of millions of dollars in direct investment in, I think, junk bonds in particular, beyond the specifically prescribed limitation. And he hires a guy named Alan Greenspan, who in turn goes out and recruits 5 senators, including John Glenn, the first man to orbit the planet, and John McCain, war hero, to go sit in the office of the S&L regulator and say, leave Charles Keating alone. That's pretty serious stuff. So, you know, it's regulators, for a regulator to be, to stand up at the time they need to is a harder thing than it sounds.
Well, you've got the other thing, because you talked about that in your lecture last year. Texas has both high property taxes and restrictions on mortgages. I think they don't allow second mortgages, and they have restrictions on loan to value ratio. Now that's happening locally, and that would seem to suggest that both local property taxes and local regulations can in fact play a major and automatic role in limiting bubbles, because as you point out in your model, these bubbles tend to happen at the fringe where the regulators aren't looking. And the Texas regulations largely, I think, certainly kept Texas from having the kind of horrors that happened in 2008.
I think it's a superb point. And boy, the banking industry, I was one of them at one point in time, Texas banker. tried to overturn that home equity limitation any number of times, but it was written in the Constitution, which made it extremely difficult to change, and it saved a lot of grief in Texas.
Well, you need more of at least that aspect of Texas around the country.
I have a question from Ed Dodson. Ed is a retired executive with Fannie Mae, and was there when Fannie Mae had their interesting times. And he asks, have you looked at the capacity of the private mortgage insurance firms to pay claims to lessen the incidence of loss to mortgage loan investors?
Oh boy.
I haven't looked at that specifically, and Fannie Mae and Ginnie Mae and the whole system, may very well be tested significantly in the months to come. But I haven't looked specifically at the mortgage insurance rates and the protection they provide.
Okay. We have a question. The notion of capacity is really interesting, particularly regarding the history of Midtown Manhattan. What do you imagine to be a future of New York City, seeing as so many companies that occupy Midtown won't need to come back because of people working from home?
Well, you're talking about something that's outside of my expertise, but I will tell you, there is an enormous amount of work being done right now by businesses and by state governments and by everybody in between. People are learning how to work from home in a way that was unimaginable 60 days ago.
Yeah.
And there is a lot of discussion about, which jobs really do need to be back in the office and which can permanently stay at home. So I don't know how profoundly that's going to change the commercial real estate market, but I suspect it is going to be reasonably profound. And, for years we worked, when I was in the private sector, we worked on ways to get customer service reps to work from home rather than in a large call center. And we achieved some success. Technology has improved extraordinarily since that point in time. And I think today that's feasible in a way that was inconceivable. I suspect there's going to be a sustained difference in the vibrancy of large cities that were built before the automobile, like, my own Philadelphia and New York and Boston and a number of others. And I think the real estate market's going to feel it for quite some time.
The first thought that came to me was that the upper floors, a lot of these office complexes could end up becoming condos.
Which would increase the supply of condos by goodness knows how much.
Oh my.
Yeah. How do you see the inclusion of forbearance as a remedy in this current crisis as different from the crisis of 12 years ago?
For the overt forbearance that's being shown right now is far greater than 2008. I mean, the Fed came out almost instantly, as did the other national regulators, the FDIC and others, and gave very specific guidance on forbearance to be granted. And really the industry adopted those with enthusiasm, because I think everybody starting in March wanted to be helpful. And so, I've never seen anything or read about anything as remarkable as the amount of forbearance that happened almost instantly in the lending industry. However, doing it for a month or two is a very different proposition than doing it for 3 months or 6 months or 9 months. So every month that goes by, it is going to become a more difficult proposition. Unless Congress steps up, the three factors at work here are, number one, whether Congress will step up with monthly stipend to consumers far beyond what's already been done. Number two, the medical solutions to COVID and how quick or slow those are. And I think that it's all dawning on all of us. It's not going to happen fast. And number three, the resiliency, you know, how quickly we can get and even want to get back to work. That's going to put an enormous amount of pressure on this forbearance idea that was easy in month one, relatively speaking, will be much harder as we go forward. So we've done things, I think, heroically in the first couple of months of this crisis. It's going to get tougher.
Okay. David Weinberg asks, can the states create a mortgage jubilee without the Fed or Treasury?
Well, the issue is really the mortgage holder, because what you're really doing, and the mortgage holder in some cases is Fannie Mae and other GSEs. The mortgage holders are private, you know, pension funds and life insurance companies. So if you create a permanent jubilee or a much longer term jubilee, you're really taking money out of the pockets of those investors. And the states really don't have authority to do that. You know, I would think that really it's only the federal government, and only if the federal government provides the funding to support that kind of relief. So I think it happens between mortgages and rental. Those two happen to be the biggest questions out there to me, and a part of a very long list of questions. They just happen to be the biggest two factors. And how we solve that, and if we solve that over the next few months, is the biggest question to me.
It occurs to me that different states have very different bankruptcy laws, particularly with regard to primary residence. I understand in Florida, it's extremely difficult to foreclose on somebody's
And different homestead laws and the like.
Yeah. And they might also have different eviction laws with regard to renters. But I think changing those things abruptly after a loan has been made would raise the hackles of bankers. Although they changed them abruptly in the favor of against the bankruptcy under the Bush administration, the second Bush administration. They made it much harder to get a bankruptcy, but the debtors don't have much of a lobby, so I guess that was okay. Does more private debt produce more speculation and inflation than public debt is Warren's? I think that's just a yes.
I want to be careful there, though, because a lot of folks, when they talk about inflation, are talking about, you know, everyday price inflation, you know, the cost of food and going to the movies and, you know, that sort of thing. And I don't think there's any evidence that increased private lending impacts that type of inflation. And in fact, if you look over the entire post-war period, there looks to be an inverse correlation between the amount of debt and inflation, defined as we do in the CPI and so forth.
Yeah,
if we define it as asset inflation, the cost of land, which is a subject that you guys are experts in, and the cost of buildings and things like that, I would say there's a direct causal relationship between the amount of debt and the price of assets. So I just want to be careful about making that distinction.
Okay. Ed Dotson just corrected I said mortgagee. The mortgagee is the lender and the mortgagor is the borrower. That's just a correction of something I had said. Warren, again, this must be Warren Chamberlain because he tends to be biblical. Forgive us our debts as we forgive our debtors. And with that in mind, it was Matthew. Where did I see that? Somebody posted it in the chat rather than the. This doesn't have a good search. That thing about the king who was hard on his unforgiving debt collector is from Matthew something. I'll have to find it again.
It's Sunday morning. You guys ought to have, or Sunday afternoon. You guys ought to have that down on a Sunday.
Does anyone want to comment on whether the theories of George have any relevance to understanding some of these historical patterns? I can point you to a good paper on my website. It's Saving Community. It's Stephen Zarlenga of the American Monetary Institute wrote about Henry George's monetary views. And about halfway down the paper, he actually gets into quoting George. First half is his opinions about George, which are not bad, but are less useful. But it's savingcommunities.org/docs, D-O-C-S, for documents. And if you scroll down to George, Henry, you'll see Henry George's monetary views there. But yeah, Henry George was a greenbacker, so he wanted government to issue the money. He saw the banking privilege as something where they're basically lending money that they don't have, that they didn't earn. I always said 100% reserve would this will antagonize the bankers as much as Michael Hudson does. I always said that what do you call it? Pawnbrokers, that if we went to 100% reserves, it would pull the banking industry up to the moral equivalence of pawnbrokers, because pawnbrokers are actually lending their own money. But yeah, George was very clear that it's the proper function of government to issue money. So.
Can I put in a question? You sort of jumped past the issue of pensions and pension funds, which are at least in part state regulated, and I think that's also part of your department. And wondering, how is Pennsylvania dealing with the crisis in pension funds that we're certainly looking at?
Well, I'm not at liberty to speak to the specific circumstances of Pennsylvania's large pension funds. I will say generally that in my experience, they do a very good job in Pennsylvania and have addressed the problems of things like underfunding vigorously and well. But, generally, if I think about the entire United States, I think the pension shortfall, as reported in the Federal Reserve Z1 report, is close to $2 trillion. Mm-hmm. And I think the consequence of that has been constrained ability of the pension funds to, or not the pension funds, but the states to invest all that they would like to invest in education and infrastructure. I mean, that's we've examined that from 1970 forward on a expenditure to GDP basis across the entire spectrum, and that's clearly where the increased spending in pensions has been coupled with decreased spending as a percent of GDP in education and infrastructure. Now, I think the comment earlier was, can't you use debt to fill that gap? Debt such as might be provided by a state's own bank. And I would just say to you that debt has been used from time to time to fill gaps, and it really doesn't address the fundamental problems. They're stopgap way. They tend to be a stopgap solution that doesn't address the more core issues of pension reform and increased funding from the legislature. So, there's no reason not to consider things like that. I tend to view them as stopgap.
Well, there's also taxes. So.
Yeah, taxes, which as well said, and that taxes, are in essence still the same thing, which is money that might be going somewhere else, has to go to pensions instead.
I would just note that our pension fund is required to be privately invested by Pennsylvania law, and our pension fund was in much better shape in 2007 than it was in 2009. So, you know, a lot of that is outside, you know, the claim of the conservative side of the legislature is that we were too profligate in issuing these pension contracts, and it doesn't seem that that was a good argument in 2007, and it magically became a good argument in 2009 because the stock markets and the mutual funds and whatever that we had these pensions invested in tanked. And that's kind of outside of the question of whether the pensions were too generous in the first place. I mean, whether they were or they're not, it's the problem that that created that. Fred Foldbury again, did not the Fed push interest rates down after 2001? Did not cheap credit fuel the land speculation and building boom?
The answer to that is yes. I mean, you know, the simple answer to that is yes. We looked really hard at the correlation of declining interest rates and a credit boom, and you know, sure enough, it's there on many of the occasions, but on many of the occasions, it's not really there. You know, interest rates are pretty flat in the period leading, you know, accompanying a credit boom. What I can say is you tend not to have periods where you have credit booms when interest rates are rising. So, you know, I think there's a link there, but having been on the inside and, you know, and from my most formative early years in banking and through multiple crises, is that bankers don't need, they're helped by lower rates, but it's not a requirement for bankers to lend aggressively, nor is it an impediment to borrowers to borrow more when interest rates aren't lower. You have plenty of examples of profligate lending when interest rates have not declined.
I remember in the 70s, people were borrowing because they were afraid interest rates were going to keep getting higher. It's the same thing as the land prices going up, you better buy now. In the mid to late 70s, it was like the interest rates are going to be so ridiculous this year or next year that I better buy and pay a ridiculous interest rate this year. It'll only get worse.
Well, I'll bet there's a lot of crazy speculative investment in COVID cures already too.
Well, here's a very speculative question. This is beyond speculative exuberance. Could the future of gaining massive access to extraterrestrial resources, I think that means mining asteroids, and material production create so much earth wealth as to have the same effect as a debt jubilee for humanity?
I'll let Polly handle that one.
Folks, I said, depends on how it's distributed.
Yeah. We'll let Isaac Asimov handle that one.
Folks, I want you to know that it's been a real privilege to be with you today. Maybe I have an obligation I need to get to, but if we got one or two more questions, I'd be happy to take those.
No, we got like 14. So we can, if you have to go, we can stay on and kind of deal with them. I think.
Well, why don't we try to get them answered by 2:30 and then.
Okay. Warren says, what if the Fed was allowed to buy Treasury notes directly so the Treasury could spend money into the economy? I think it is buying back the Treasury notes right now in order to do that.
Yeah, I don't think there's much difference between what it's doing now and that. And we have seen that the Bank of England has recently adopted that very posture. They're buying debt directly from the Treasury. I think some of that may actually be occurring in Japan too. But I don't think there's a great deal of difference between the Treasury selling to a primary dealer and the Fed buying it from that primary dealer, you know, the next hour or the next day. You get to the same place, and effectively that's a good bit of what is happening now. And it is a way to replenish the Treasury's checking account at the Fed very, very quickly.
Okay, Warren has several questions. I'm going to try to get everybody in. You propose better regulation, but what about the public choice problem? What if we have the wrong regulations? What if regulators push banks to lend to high-risk potential borrowers, as in fact happened in the lead up to the Great Recession?
Yeah, to me, there's a lot of regulation that is, either misguided or superfluous. I've lived through a lot of that regulation myself. There's one regulation in particular that I advocate here, and it's the simplest possible one. And that is for the regulators to look at the ratio of private sector lending to GDP. And in any period where, let's call it a 5-year period, that ratio increases by 20 percentage points, which would mean you've had several years in a row that ratio is increased by about 4 percentage points. So I would almost use as a rule of thumb, if you have a couple of years where it increases by 4%, that's a huge amount. And that would be the signal for the regulator to intervene and examine the credit policies of the institutions. And here's one other point I didn't make earlier that I would make emphatically now. There's never been a crisis that we've studied where the things that were going on were subtle. Instead, in every single crisis, it is blatant, flagrant behavior that brought about the overlending. So it's not as if you're looking for a needle in a haystack. If you see that lending has grown by that amount for a couple of years, in every situation we've examined, everybody knows who's doing it and where it's happening. And it's just at that point in time up to the regulator as to whether they're going to be willing to intervene or not. But the regulation required to me is a pretty straightforward and simple one.
That's what our attendees say.
Richard recommended a book called Mortgage Wars by Tim Howard. I don't know if you know that or not. China holds one point. Go ahead.
Go ahead. No, go ahead. You're about to.
China holds 1.1 trillion of U.S. debt. What if they call the loan? I would be more worried about that 3 months ago than I am now. I think China needs to worry that we freeze the assets to pay for the damage of their virus. But
I've heard this concern expressed for 20 years now, that or 15 years, that China holds. First of all, China doesn't hold a lot of our debt. We've got 22 trillion in debt, of which China holds $1.3 trillion. So there's not much to begin with. Secondly, China, it won't matter a whit. I don't want to use language that's overly strong here, but it wouldn't matter a whit if China decided to sell all of its treasuries or what have you, because the only way for China to really stop accumulating dollars is to stop exporting to the United States. And how realistic is it to think that China's going to do that? So that's the only real choice they have, is to shoot themselves in the foot. The only reason they have those dollars in the first place is because they have an export surplus with the United States. Mm-hmm. So anybody who spends a moment worrying about China's disposition of the debt it holds for us is spending time worrying about something that has no chance of happening.
Lee Hatchadorian wants to know, he's looking forward to your book. He wants to know, did you find any evidence that were not precipitated by overlending, or by overlending not tied to real estate?
There was in the 19th century, you had a lot of railroad crises. So you did have instances where they built way too many railroads. I don't know if my memory is correct on this or not, but I think there were 25 different railroad companies servicing the city of Chicago. That was probably 22 more than you needed, and so there was overcapacity created there. The 1907 crisis was a lot about copper, because copper was not only used for railroads and for industry, It was also used for the brand new, circa
Telegraph.
1880 electricity utility industry. All of a sudden, this was extraordinary demand. And so a bunch of banks decided a bunch of trust banks decided they wanted to get rich by financing copper mines and other things like that in the 1900s. So I would say that most of the time, there's no lending sector large enough to matter nearly as much as real estate. So land and real estate tend to be where it happens, but it's not always the case. In Asia in 97, most of the overlending was to the manufacturing sector.
Yeah, we would include, Georges would include copper mines as part of land speculation. And I think that railroad and streetcar franchises are essentially the railroad and streetcar right-of-ways are a unique type of land title. So
That makes sense.
Why does all our money issued as debt, couldn't it just be spent directly into circulation?
That's actually a great question. That in today's world, essentially all money is created as a byproduct of debt. When the Treasury issues securities, it's obviously debt.
Yeah.
When the Fed buys securities from banks and credits their reserve accounts, that's a liability or a debt. When a bank makes a loan, it's debt. So pretty close to 100% of all the money that's created every day these days, and for the last, goodness knows, at least several decades, is all debt related. I would actually argue there have been periods in history where money has been created without commensurate debt. And we remember many of these vividly. It was like, the money that was printed to pay soldiers in the American Revolution is a great example of that. And to me, in a way that economists do not tend to think about or appreciate, those are two very different kinds of money that is created by debt and money that is not created by debt. My belief, and it's hard to put a case together for this, but my belief is money created by debt does not and cannot create and has not created price inflation in the way that people obsess about. Money created that's not associated with debt creation has created inflation and can, and that's in the Confederate States of America is another example. I believe, it's hard to find all the data on this, I believe that's part of the equation in the Weimar Republic. Certainly the case in Zimbabwe and places like that. So we can create that kind of money. We could tie it to another asset. There have been debates about this going back, a couple hundred years, tying it to land, as you guys know, instead of to debt. So there can, and it's my own view that a limited amount of this is probably a healthy thing, as long as it is limited. And that's probably an hour-long discussion of its own, but it's an interesting question, and I think ultimately a very important question.
Well, I think we're on our last question, and it's because Ed Dodson's the Fannie Mae guy, so it's technical. One factor that pulled up property prices was the competition for transactions volume between commercial banks issuing private label mortgage-backed securities and GSEs responding to try to maintain market share. The private label business was the source of fraud. For the GSEs, the loss of market share exposed them to shortfalls in risk-based capital requirements. That sounds...
Stated simply, competition among lenders often leads to overlending. I mean, that's an easy way to think about a technical question there. Absolutely. The private mortgage markets were trying to make headway in a boom because it was, I can remember guys saying, oh my goodness, this has been like 04 and 05 and 06 guys. And we should, commercial banks saying we should buy a mortgage company. I'm sitting there going, why? Well, it was a boom. It was a way to make a lot of money. So yeah, there was a lot of that going on, and it gets back to the herd mentality, to the frenzy, to the fear of missing out that we've discussed here. Economics is a behavioral science, not a physical science. Herd mentality, group behavior is a huge part of it.
Yeah, that's Schiller.
That pretty much wraps it at our end, unless you have some closing remark that you would like to
can't
say.
tell you how grateful I am to you, Dan and Polly. It's a real privilege to be with you this afternoon, and I appreciate the work that you do.
Well, thank you very much. It's
Well,
been
thank
great
you for the
having you
work
on
that you
here.
do.
Well, let's
Thank
do it
you.
again sometime.
Okay, and so I guess we're pretty much done. I want to once again thank Robert Schalkenbach Foundation for helping us cover the costs of doing these things. And this should be on YouTube in at least by tomorrow on the Council of Georgist Organizations page under YouTube. So
Thanks again. Signing
you.
off.
Thank you.
Thank
Thank you.